Hello friends, today's topic is BEPS Action Plan number 15, Multilateral Instrument. This is the last action plan of the OECD, and herein we will be studying what is the meaning of multilateral instrument, what are the features of multilateral instrument, history of introducing MLI, and what are the corresponding India chapter, or you can say what is the position in India regarding multilateral instrument. So friends, last BEPS action plan number 15, multilateral instrument, one of the most important BEPS action plan, which sees the implementation part of all the BEPS action plan. So it is through multilateral instrument, it is through BEPS action plan number 15 that the minimum standards that the minimum standards of the BEPS action plan are being implemented. So whatever is to be implemented are implemented through amending the double taxation avoidance agreement, and the same is coming from BEPS action plan number 15. So the scenario is you have double taxation avoidance agreement, existing double taxation avoidance agreement between countries. Intention was to avoid double taxation, and intention of BEPS action plan is to avoid non-taxation, is to minimize the risk of low taxation through strategies adopted by several MNE groups at a global level. And this intention of non-taxation is practically implemented through BEPS Action Plan number 15, multilateral instrument, wherein the existing double taxation avoidance agreement are being amended, wherein a flexibility has been provided to the tax administrators, to the member countries, wherein they will step by step bring in at least the minimum standards. They have to bring in the minimum standards. It has been recommended by BEPS Action Plan number 15, which has been recommended by all the BEPS Action Plan. Certain minimum standard are, for example, preventing treaty abuse, Action Plan number 6, improving dispute resolution as per Action Plan number 14. So this minimum standards are mandatorily to be implemented in the double taxation avoidance agreement, as well as for other provisions an option is provided to the member nations. Either they can opt it or they can reserve to the non-mandatory provisions mentioned in the BEPS action plan. However, the minimum standard are to be implemented necessarily in the existing double taxation avoidance agreement, which is being implemented through BEPS Action Plan number 15, multilateral instrument. We will come to the background of it, history of MLI in the subsequent slides, wherein there was proposal of forming an ad hoc group which will foresee the implementation of MLI. So there was formation of ad hoc group which comprised of more than 100 countries including India. This ad hoc group suggested report of the multilateral instrument for implementing the BEPS action plan, and once this report came into being, countries were asked for commitment towards implementing the minimum standards in 2017. So it all started in 2015, Feb 2015, where a proposal of formation of ad hoc group was proposed, In around May 15, the ad hoc group was prepared, comprising of 100 companies, 100 countries coming together, including India, who formed the ad hoc group and suggested measures for implementing multilateral instrument. In June 2017, around 67 countries, including and also 9 jurisdictions, signed a pact amongst themselves to signed a pact for intention being to implement the minimum standard in the existing treaties. And India submitted the MLI position. India submitted its MLI position in 2019, June 2019. And the MLI provisions are coming into effect for India in April 2020. Here you would see there are various concepts: cover tax agreement, ratification, adoption of the MLI positions, entry into force, entry into effect. There are various terms you should be used to for understanding multilateral instrument, which will be coming in the subsequent slides, which we will be discussing in the subsequent slides. So friends, on your screen, Multilateral Instrument Action Plan number 15, implementing. The purpose of MLI is nothing but implementing the tax treaty related measures developed through BEPS project in the existing bilateral tax treaties in a synchronized and efficient manner. So the purpose being implementing the tax treaty related measures developed in the BEPS project, meaning the BEPS Action Plan are to be implemented in the existing bilateral tax treaties in a synchronized and efficient manner. These measures will prevent treaty abuse, improve dispute resolution, prevent the artificial avoidance of PE status, permanent establishment status, and neutralize the effects of hybrid mismatch arrangement. First two, preventing treaty abuse and improve dispute resolution are minimum standards of BEPS. Number 6 and number 14, and the last two are not a minimum standard but are recommended by MLI, but are recommended in BEPS Action Plan 15, which needs to be addressed through MLI, which is avoiding PE status, artificial avoidance measures for artificial avoidance of PE status, and hybrid mismatch arrangements, neutralizing the effects of hybrid mismatch arrangements. Artificial PE status is nothing but action plan number 7, and hybrid is related to action plan number 2. So 4 standards, 4 action plans have been mentioned over here, which will be particularly addressed in BEPS Action Plan number 15, which are particularly to be implemented by the member countries in the MLI as part of the process of MLI. Now friends, coming to history of MLI, formation of ad hoc group to develop MLI. Based on this analysis, which is analysis of what are the effects of BEPS, what is the meaning of BEPS first, was analyzed, how to suggest measures, how to bring in measures to remove the effects of BEPS was discussed earlier to the implementation of MLI. So first is BEPS, which came in 2013, and when the action plans were prepared based on measures implementing what is BEPS and what are the points to be considered, what are the measures to be undertaken for countering BEPS. It was cut start. It was decided in 2013 up to 2015, and once all the BEPS action plan came into force, or we can say all the BEPS action plan report on the same was submitted when by the committee. When it was submitted, one of the action plan 15, one of the action plan, which is action plan 15, was multilateral instrument. So first, BEPS action, all the plan of the BEPS action plans came into being, and then action plan number 15, multilateral instrument, was suggested in 2015. So based on the analysis of the BEPS measures, the effects of BEPS, a mandate for the formation of an ad hoc group to develop MLI was approved by OECD committee and endorsed by G20 finance ministers and central bank governors in Feb 2015. So based on analysis of BEPS measures, it was suggested that an ad hoc group should be formed to develop MLI, which was approved by OECD committee and endorsed by G20 finance ministers, and it came into picture in Feb 2015 in line with Action 15 report. An ad hoc group was formed with a predefined purpose of developing MLI. India was part of the ad hoc group of more than 100 countries and jurisdictions from G20, OECD, BEPS associates, and other interested countries, which worked on equal footing on the finalization of the text of multilateral convention starting May 15. So the group was formed in May 15, purpose being finalization of the text of the multilateral convention, which is another term for multilateral instrument. So a multilateral convention was supposed to be developed, was intended to be developed by the ad hoc group of more than 100 countries, which includes India. And it all started in May 2015. The text of the convention and the accompanying explanatory statement was adopted by the ad hoc group on 24th of November 2016. So with effect from 25th of November 2016, the measures related to multilateral convention, the text of the multilateral convention came into existence along with the explanatory statement. So for multilateral convention there are two documents, one the bare provisions and other explanatory statement, which is supporting the bare provisions of MLI, bare provisions of the text of the multilateral convention. So this both the documents are to be read together in sync with each other. So text of the convention was accompanied by explanatory statement, and the same was adopted on 24th of November 2016. So intention of formation of ad hoc group in Feb 15, group was formed in May 15, and the text of the multilateral convention was adopted on 24th of November 2016. Now friends, signatories to the MLI, meaning the parties, the treaty parties, the member nations to the MLI, wherein in 7th of June 2017, 67 countries and 9 jurisdictions came together and showed their intention of bringing in minimum standards and other provisions of BEPS Action Plan in their respective treaty. So, in that regard, there was a signature which showed the intention of bringing in the measures in the subsequent years. So, in 2017, this was signed. If you ask for India, India took 2 years to negotiate the MLI positions with each and every treaty partners. India has around more than 110 double taxation avoidance agreement with respective countries, and during these 2 years, India has negotiated each and every article. First, the minimum standard are negotiated, then the optional provisions, if India wants to adopt, then they have tried to negotiate the same with the member countries, and once, as part of the overall process, what is the India's stand, India's position on each and every article of the double taxation avoidance agreement, on each and every article of the BEPS action plan is to be suggested in the MLI position, which India has submitted to OECD in June 2019. We'll come to that later. First of all, signatories to MLI is nothing but here the intention of implementing the BEPS provisions in the treaty is to be declared, is to be signed by the parties. Once drafted, the said document was thereafter kept open for signatures from 31st of December 2016 in the first signing ceremony of the MLI on 7th of June 2017. This, you can say, a historic day in the MLI chapter. And mind you, friends, MLI, practically if you see, is very much relevant concept. It has came into existence. It is being implemented from this very year, from the current year, from the previous year 2021. So it has been implemented in India. The India chapter of MLI has begun from 1st of April 2020. So practically if you ask, very much a relevant concept of MLI multilateral instrument, and it will have significance for another, you can say, years to come. For 2 to 3 years, people will get used to what are the process, how the procedures are to be implemented, and your existing treaty of double taxation avoidance agreement, which is almost, in case of India, more than 100, will get changed. Obviously, India and other treaty country should agree to it, and once the negotiations are over, then countries have to adopt double taxation avoidance agreement along with changes suggested by MLI. So practically very much a relevant concept. And coming back to signatories to MLI, historic day of 7 June of 2017, wherein intention was declared by 67 countries have signed the MLI and 9 countries have expressed their intention to sign the instrument. Signing the instrument in a way, 67 countries have signed that they commit in bringing the minimum standard in the existing treaties, and 9 jurisdictions have only expressed the intention. However, 67 countries, which is including India, signed that they will implement the BEPS measures in the existing double taxation avoidance agreement. As on 27th of September 2018, 84 countries have signed the MLI and 6 countries have expressed their intention to sign the instrument. And if you ask as on date, there are many more countries, much more than 84 countries. And as far as India chapter is concerned, India has already submitted its MLI position in June 2019, which involved The covered tax agreement involved more than 70 countries. However, if you see the synthesized text, which is a document which mentions the amendments related to MLI, synthesized document with the relevant countries are around 29. So the negotiations are still going on, and as far as your syllabus is concerned, you will have to understand that as on 27th of September 2018, 84 countries have signed the MLI. And at the time of, if you want to give the current picture as well, if you want to mention current provision as well, you can Google it and you will get approximately how many countries have been party to or have signed the MLI with OECD, and you will be able to obtain that on the OECD website. Not mandatory. It is enough that you remember that as on 27th of September 2018, 84 countries have signed the MLI. And from this chapter, from this entire BEPS chapter, you can expect a descriptive question. Not mandatory, however, you can expect a descriptive question, not a practical question. At the time of signature, signatories submitted a list of the tax treaties in force that they would like to designate as covered tax agreement, that is to be amended through the MLI. So from the existing tax treaty, for example in India of more than 100, India will jot down to which country, with which countries the MLI will be affected. Mean out of 100, for 70 countries, let's say 70 countries, India has mentioned that this will be covered tax agreement with this country we are negotiating. The convention enables all signatories, amongst other things, to meet treaty-related minimum standards that were agreed as part of the final BEPS project, final BEPS package. So, as part of the convention, treaty-related minimum standards are mandatorily to be implemented. Features of MLI, meaning of MLI. The Multilateral Convention is thus an outcome of OECD G20 project to tackle BEPS. Right? So first, as we had discussed, in 2013, BEPS came into picture, cut start. In 2015, BEPS came into picture. And once all the measures related to BEPS were jotted down in the points of BEPS Action Plans 1 to 15, then one of the BEPS Action Plan number 15 is Multilateral Instrument, which came into picture in 2015. Ad hoc group was prepared in May 2015, and the convention was adopted in November 2016. And the features of MLI, as we had stated earlier, as we had discussed earlier, it is a flexible instrument which will enable the member countries to choose the optional provisions recommended by OECD, and mandatory provisions are minimum standard provisions are mandatorily to be implemented in the existing treaty. Accordingly, it provides flexibility to the member countries in implementing the recommendations of BEPS. Flexibility in terms of non-minimum standards. Minimum standards are, however, necessarily to be implemented. The MLI modifies the tax treaties that are covered tax agreement. Covered tax agreement are nothing but short form is CTA, which will be more used in MLIs. CTA is nothing but covered tax agreement is nothing but, for example, India has, while submitting its MLI position, has submitted that out of 110 double taxation avoidance agreement, just an example, out of 110, only the MLI provisions will be applicable only to 70 countries. So 70 number is nothing but covered tax agreement. A covered tax agreement is an agreement for avoidance of double taxation that is in force between parties to the MLI and for which both parties have made a notification that they wish to modify the agreement using the MLI. Meaning, India has submitted for 70 countries covered tax agreement. For example, US is also mentioned in the covered tax agreement. However, US has not at all submitted any MLI position. So US is not party to any of the MLI provisions. Accordingly, what will happen is India has submitted its MLI positions stating that US will be a covered tax agreement. However, US has not submitted any of the MLI positions, meaning it has not stated any of the countries as covered tax agreement. Accordingly, since the other party, the other country has not mentioned India as covered tax agreement, then MLI provisions won't apply to India-US treaty, meaning existing double taxation avoidance agreement, existing comprehensive double taxation avoidance agreement between India and US will continue to apply and there will be no change in it until India and US mutually agrees to change it. So unless and until both the treaty partners are on the same page, MLI provisions cannot come into effect and accordingly the existing document of double taxation avoidance agreement will continue to apply. Accordingly, a covered tax agreement is an agreement for avoidance of double taxation that is in force between parties to MLI and for which both the parties have made a notification that they wish to modify the agreement using the MLI. So, both the parties should agree by way of submitting their notifications by submitting the MLI positions. MLI is a flexible instrument which will modify tax treaties according to a jurisdiction's policy preferences with respect to the implementation of BEPS measures. The MLI provides for different types of flexibility in a way jurisdictions can choose amongst alternative provisions in certain MLI articles, right? Optional provisions, they mean to say jurisdiction can choose to apply optional provisions, alternative provisions, for instance the provisions on mandatory binding arbitration. Flexibility in terms of jurisdiction may choose to reserve the right not to apply MLI provisions, to opt out to a reservation with respect to all of the covered tax agreements or with respect to subset of the covered tax agreement. Meaning BEPS measures has been suggested, cut start, meaning BEPS measures has been suggested. So if we take minimum standard preventing treaty abuse, one of the provisions was, as we have studied earlier, that LOB clause was introduced in India-Mauritius Treaty, right, wherein treaty abuse in terms of benefit of capital gains taxability in the hands of resident of Mauritius, an entity which is resident of Mauritius was taking benefit in terms of nil rate of capital gains where shares of an Indian company are transferred by such Mauritius entity. So this loophole, you can say, this benefit was curbed by way of LOB clause which was part of BEPS Action Plan number 6, right? So this was by way of protocol, right? And these are the standards which mandatorily countries have to adopt. Both India and Mauritius adopted it. However, there will always be a provision wherein which are optional, which are not mandatory, and India will have the right, or in that case, even Mauritius will have that right, that not to adopt that provision either for India Mauritius treaty or in case of India for with other treaty partners with other countries. So if particular provision, let's say transparent entity provision, which is as per action plan number 3, practically India has not adopted, has chosen not to adopt this action plan since it is not mandatory. India got an option wherein India has chosen not to opt for the transparent entity action plan number 3. So here we can see that MLI is a flexible instrument which will provide flexibility to the member countries whether to adopt an optional provision or not, or whether to reserve to a particular kind of provision suggested by BEPS Action Plan. So, a flexible instrument providing flexibility to the member countries in terms of opting out or reserving a particular measure suggested by BEPS Action Plan. So, friends, this was related to features of MLI, wherein it is nothing but an outcome of BEPS measures and the concept of covered tax agreement we have covered, and flexible instrument. MLI, one of the features of MLI is it is a flexible instrument for modifying the tax treaty. And also, jurisdictions only have the possibility, the member countries have only the possibility to opt out of provisions that do not reflect a BEPS minimum standard, with the possibility to withdraw their reservations and opt in later. So minimum standard are mandatorily to be adopted, and optional provisions can be adopted at a later point of time by the jurisdictions. Amendment of MLI position. MLI position is nothing but you are mentioning in your position while submitting to the OECD, you are mentioning in the MLI position that which are the covered tax agreement, which provisions you have opted out for, which optional provisions you have opted yes, and which optional provisions you have opted as out, opted as no, or another word is you have reserved for certain provisions. So MLI position contains all the documentation wherein provisions opted for are mentioned, provisions not opted for by the jurisdiction are mentioned in the MLI positions. So amendment to the MLI position, you can say from 2017 of intention of signing the report, which was 7th of June 2017, and India has submitted its MLI position in June 2019. So for 2 years, India will be able to amend all the negotiations, all the ratifications with the concerned countries, with the concerned treaty partners. So amendment in MLI position was available till the date of submission of the MLI position. Also, after submission of MLI position, India can always mention that certain provisions which they have reserved for which they haven't opted for can be opted in at a subsequent stage at a stage after submission of MLI position. So amendments of MLI position, friends, the provisional MLI position of each signatory indicates the tax treaties it intends to cover tax agreement, the options it has chosen, and the reservations it has made. These two are only for optional provisions. For minimum standard, it has to be adopted. So MLI position is nothing but documentation on covered tax agreement, documentation the option which has been chosen, and documentation on the reservations made on the measures of BEPS Action Plan. Signatories can amend the MLI position until ratification, until you have submitted your MLI position to the OECD. Even after ratification, even after submission of the MLI position, parties can choose to opt in with respect to optional provisions or to withdraw reservations. So subsequently, post ratification, if countries' position change, if they want to opt in for a particular provision, then they can do so by informing OECD in this regard. So friends, amendment of MLI position. Now starts the India chapter. India chapter signed by India on the historic date at Paris, France on 7th of June 2017, which was signed by 67 countries together. India had ratified the said convention and had deposited the MLI position along with the list of covered tax agreements, reservations and notification, which is India's position under the said convention, to the depository, which is with OECD, on 25th of June 2019. So as we had discussed earlier, India's MLI position was deposited with OECD on 25th of June 2019, and once the MLI position is submitted, then the concept of entry into force and entry into effect, meaning in the case of India, 25th of June 2019 was the date of deposition of MLI position. 3 months after that, which will be 1st of October 2019, the Multilateral Convention comes into force. There is entry into force of the Multilateral Convention post 3 months of deposition of multilateral position. The convention comes into force after 3 months, and from the date of 25th and from the date of 1st October 2019, 6 months thereafter, the convention, the multilateral instrument, will come into effect. Meaning 6 months after 1st of October 2019, it is nothing but 1st of April 2020. And as we had discussed earlier, multilateral provisions are coming into effect. In case of India, the India chapter of multilateral begins from previous year 2021, that is from 1st of April 2020. The multilateral conventions will come into effect for India, and this is how post ratification of the document, 3 months plus 6 months entry into force, entry into effect respectively. This is why the provisions of MLI This is how the provisions of MLI is applicable from previous year 2021 in the case of India. Also, having said that, if we see treaty by treaty analysis, treaty by treaty coming into effect will differ because it depends upon, in multilateral convention, it always depend upon whether both the parties, whether both the treaty parties, whether both the treaty partners have agreed to a provision or not. Let's say India, Singapore. Singapore has submitted its multilateral convention with OECD in December 2018. So 3 months plus 6 months in their case, entry into effect was earlier than India. So when you are seeing India Singapore double taxation avoidance agreement, the changes in multilateral instrument, the effect of multilateral instrument will be effective only when both the countries have submitted the MLI position. In case of India Singapore, India was the second country who has submitted. India has submitted later than Singapore. So for both the countries, entry into effect positions will be April 2020, right? And for example, if Singapore would have submitted the MLI position in December 2019 instead of December 2018, then the entry into effect of multilateral convention will be shifted to the next previous year, which is 21-22. And here the entry into effect provisions are divided into two. One is tax rate of withholding and other taxes levied. Both the, you can say, both the department or both the bifurcation, the entry into effect will be different, which we will be covering in the subsequent slides. However, for the time being, you can remember the simple concept of deposition of MLI, then entry into effect and entry into force, which is 3 months and 6 months. The date of entry into force of the said convention for India is 1st of October 2019, which is 3 months post the submission of MLI position to the OECD, being the first day of the month following the expiry of 3 calendar months beginning on 25th of June 2019, being the date of deposit by India of the instrument of ratification. So 3 calendar months has to be seen from 25th of June 2019 till 1st of October 2019. So this is date of entry into force. The provisions of the said convention would have effect in India, which is date of entry into effect with respect to the covered tax agreement in accordance with the provisions of Article 35 of the said convention, right? So after date of effect, then after date of entry into force, then date of effect comes into picture, which has been mentioned in Article 35 of the MLI document of the MLI convention. Accordingly, in exercise of the powers conferred by Section 90, subsection 1 of the Income Tax Act, the central government has via notification 57/2019 dated 9th of August 2019 notified that the provisions of the said convention, the provisions of MLI convention, shall be given effect to in the Union of India in accordance with India's position under the said convention as set out in the annexures thereto. This is the procedural thing wherein once the MLI position is submitted by India, deposited by India, then in order that they are brought in the domestic tax provisions, they are brought in the double taxation avoidance agreement. This notification was issued by central government on August 2019. So a notification, just a procedural requirement as per section 90 subsection 1 of the Income Tax Act. As per Article 35 MLI, which will see date of effect, date of entry into effect, the provisions of this convention shall have effect in each contracting jurisdiction with respect to the cover tax agreement. So point A and point B are nothing but tax withholding, TDS provisions applicability and other taxes provisions applicability, which will be in the case of TDS, the entry into effect will be from the first day of the next calendar year, and here calendar year for India, it will be financial year. In the article provision in the multilateral convention, it has been mentioned as a calendar year, and also there is an option given to respective jurisdictions to either opt for calendar year or opt for cut start or opt for financial year. India has opted for financial year. So the TDS provisions will be applicable from the very first day after 1st of October. From very first day after 1st of October, the start of the financial year date for India after 1st of October 2019 is April 20, right? So the date of entry into effect in case of TDS provisions will be applicable from the first day of the next calendar year, and in the case of next calendar year, next financial year, in the case of India, from 1st of October 2019, the immediate first day of the next financial year is 1st of April 2020. And for other taxes levied other than TDS, after expiry of 6 months from the date of entry into force. In case of India, the date of entry into force, we have taken an example of India Singapore. Singapore had submitted the MLI position in 2018 and India submitted its MLI position on June 2019. So whichever is later, whichever country has submitted later the MLI position, India submitted, accordingly 1st October 2019 will be the date of entry into force for both the countries. In terms of India, if we see, TDS provision will be applicable from the very first day of the next financial year, which is 1st of April 2020, and in the case of other TDS provisions, other taxes levied, it will be 6 months, which will be 6 months from the date of entry into force, which is 1st of October 2019. 6 months thereafter is again nothing but 1st of April 2020. So coincidentally, for TDS provisions as well as for other taxes levied, the date of entry into effect is same, that is 1st of April 2020 in the case of India-Singapore Treaty. If, for example, Singapore would have submitted its MLI position in December 2019, then TDS provisions will be date of entry into force for India-Singapore Treaty will be 3 months after December 2019, which is nothing but 31st of March. You can say, let's take an example, 31st of March 2020, and first day of the next financial year for TDS provision is 1st of April 2020. However, 6 months from 31st of March 2020 would have been September 2020, and accordingly the provisions of other taxes levied would have been applicable from previous year 21-22, and TDS provisions will be applicable from 2021. This is how the entry into effect may differ for TDS provisions and other taxes levied. But however, having said that, you have to understand this. I mean, it has practical significance, of course. However, for your examination, a descriptive question could be asked. So theoretically, you will have to remember the dates when the date of entry into effect is coming into picture. And we have understood this by way of an example of India-Singapore Treaty. So friends, with respect to taxes withheld at source on amounts paid or credited to non-residents, where the event giving rise to such taxes occurs on or after the first day of next calendar year that begins on or after the latest of the dates on which conventions enters into force for each of the contracting jurisdictions to the covered tax agreement. So basically Article 35 states date of entry into effect, and for taxes withheld at source, as discussed, the date of entry into effect will come into picture on or after the first day of the next calendar year. In India terms, it is financial year, which is April 2020 in our example. With respect to all other taxes levied by that contracting jurisdiction, for taxes levied with respect to taxable periods beginning on or after the expiration of period of 6 calendar months or a shorter period if the contracting jurisdictions notify from the latest of the dates on which this convention's entry into force. So 6 months from the date of entry into force for each of the jurisdiction to the covered tax agreement. Meaning we had taken two examples. Singapore submitting his MLI position in December 18, then what are the implications? And Singapore submitting the MLI position in December 19, for example, then what will be the position? What will be the change in the date of entry into effect? So friends, all other taxes levied, the period is on or after expiration of 6 calendar months. Therefore, the earliest date when the provisions of this convention can take effect in India is 1st of April 2020, 6 months from 1st of October 2019, the date of entry into force for India. So always the sequence of events will be submission of deposition of multilateral position MLI position of a particular country with OECD. From that date, 3 months thereafter, date of entry into force come into picture, and thereafter for determining date of entry into effect there are two bifurcations: for TDS provisions and for other taxes levied. In the case of India, MLI position generally will come into effect from 1st of April 2020. If MLI position by the other country has been submitted before India, if MLI position by the other country has been submitted after India, then the MLI provisions will be deferred, will be applicable only after previous year 2021. So friends, this concludes MLI provision, wherein we have studied, we have discussed that practically it has a lot of significance. However, for syllabus purpose, a descriptive question may be asked, and also it has a lot of other provisions. I mean, it contains articles therein from Article 1 to Article 39. There are various part involved in it, which it could go up to 5 to 10 hours if we discuss those articles. But however, for a syllabus purpose, these provisions are enough, and a descriptive questions could be asked not only for Action Plan 15, but for other action plan as well. So your entire chapter of BEPS, you may expect a descriptive question on BEPS and not practical question. So first of all, in BEPS Action Plan number 15, we understood what is multilateral instrument and how it is helping in implementing the minimum standards mentioned under BEPS Action Plans. Then formation of ad hoc group, which was in May 2015, which included India and other 100 countries. Then text of the Multilateral Convention, text of MLI came into picture on 24th of November 2016. Signatories, the historic day of 7 June 2017, wherein intention of signing MLI came into picture. Then features of MLI, it is nothing but one of the measures, one of the action plan of BEPS, cover tax agreement concept, flexible instrument. MLI is a flexible instrument wherein flexibility is provided to the jurisdiction, to the member country, where which provision should be adopted and which provision should be reserved, and that option is available only for non-mandatory, non-minimum standards. For minimum standard, the country do not have any option, do not have any flexibility, they have to adopt those measures. Amendment to MLI position. There are two amendments possible: till the date of ratification, till the date of deposition of the MLI position. Jurisdiction is free to amend the MLI position. Post deposition of MLI position, in the case of India, post June 2019, India can suggest amendment in MLI only in terms of provisions related to which India has not opted for, which India has reserved for. Only that provisions can be suggested for amendment in MLI position post deposition of the same to the OECD. India chapter signed on 7 June along with 67 countries. MLI position was submitted on 25th of June 2019. Then the concept of date of entry into force, which is after 3 months, and then date of entry into effect, which is 6 months for other taxes levied, and first day of the next financial year in case of TDS provisions. And entry into effect are mentioned in Article 35 of Multilateral Convention. So friends, this concludes the last BEPS Action Plan number 15, which is Multilateral Instrument. And with this, we conclude the chapter of Fundamentals of BEPS, and we will be discussing the summary of the BEPS Action Plan, the table that we had prepared initially, which we had told that we will be discussing. Once we have discussed all the BEPS Action Plan, we will be coming back to that table. Thereafter, let's take the summary of the table which we had discussed earlier. Cut. For the editor, after this video, I will be continuing with the summary of the BEPS section table post this video, which will be for around 5 minutes. So friends, after understanding all the BEPS section plan from 1 to 15, this is a summary table which we had deferred at the time of understanding the background of BEPS, and we had agreed that we will be discussing this once we have concluded, once we have discussed all the BEPS section plan from 1 to 15. So now continuing with the summary, in this tabular form you will see that action plans have been mentioned from 1 to 15, and in the third column classification has been done as per objectives. Objectives is nothing but the three pillars of BEPS, which is coherence, substance over form, transparency. And there is another category, another objective, which is horizontal, right? And apart from horizontal, all the three, coherence, substance over form, and transparency and tax certainty, are the three pillars of BEPS. Coherence is nothing but, to reiterate, it is nothing but a particular income, a particular transaction will be deduction in the hands of one person and income in the hands of another person. Through coherence, international countries have to make sure at an international level that MNE is that a particular country, if a deduction is given by a particular country, then that particular income should be taxed in the hands of other person. That should be made sure through the concept of coherence. So friends, classification, the fourth column is classification as per outcomes. Outcomes is nothing but minimum standard or common approaches or best practice, which are the optional provisions. So the bifurcation will be like either action plan is minimum standard, either it is an optional provision, which is in that case common approaches and best practices, and the third option will be reinforced international standard, wherein such standard should be brought in by the jurisdiction. Such cut start. The third portion, which is reinforced international standard, should be brought in by the jurisdiction in the domestic tax provisions, either in the domestic tax provisions or should be implemented in the existing treaty by way of protocol. So reinforced international standard are to be implemented straight away in the domestic tax provisions or in the double taxation avoidance agreement. So let's move action plan wise. First is digital economy, wherein classification as per objective and as per outcome is horizontal. In a way, we can conclude over here, we may conclude that horizontal is nothing but without changing the existing provisions of the law, and another provision is coming into picture, right? So equalization levy, you can say equalization levy is nothing but you cannot term it as tax, and it is not part of the Income Tax Act, it is part of the Finance Act. So without changing the existing provisions of the act, a new levy has been enforced, which is by way of equalization levy in terms of digital economy. Accordingly, the term horizontal, which is classification as per objectives as well as outcomes. Again, I am repeating, the fourth column is classification as per outcomes, not objectives. Second action plan is neutralizing the effect of hybrid mismatches. Objective, if we see, one of the three pillars is coherence, wherein we took an example of transparent entity. One country was taxing it and another country was providing deduction. So there was a benefit of double deduction to the entity, to the MNE entity. Accordingly, the objective in which the second action plan falls is based on the concept of coherence, and it is not a minimum standard, meaning it is a common approach and best practices. Third action plan, strengthening the CFC rules, strengthening the controlled foreign company rules. There is again, it is based on concept of coherence, and it is not a minimum standard. Limit interest deductibility 94B as per India domestic tax provisions, based on concept of coherence, wherein excess deduction is being taken by other member countries by increasing the interest rate on the loan borrowed by an Indian company. So based on concept of coherence and not a mandatory provision. However, India has adopted in its domestic tax provisions section 94B in line with BEPS Action Plan number 4. BEPS Action Plan number 5th, it has two components. First is preferential tax regime, which is substance over form. Whenever a preferential tax regime is provided, there will be a peer review on it, and if the preferential treatment leads to BEPS, then the country has to withdraw that preferential tax regime, and accordingly Such a preferential tax regime is a minimum standard. It has to be adopted by the member country. And objective is substance over form. Substance over form is nothing but, remember the concept of beneficial ownership and legal ownership. Remember the provisions of clubbing provisions as per section 64, wherein asset is transferred to the spouse without any adequate consideration. It will continue to remain taxable in the hands of transferor. So here the beneficial ownership was the transferor and the legal ownership was only the transferee. So remember the concept of beneficial ownership, legal ownership in case of substance over form. And second component is exchange of information, which is nothing but third pillar, transparency, and it is a minimum standard. So BEPS Action Plan number 5 is a minimum standard to be adopted by the member country. Fifth, again a minimum standard, preventing treaty abuse. Practically also very much important. If you see India chapter, if we had discussed in the case of India chapter, LOB clause of India Mauritius Treaty of India Singapore Treaty. It is based on concept of substance over form and it is a minimum standard. Next, preventing artificial avoidance of PE status, permanent establishment status. It is nothing but based on substance over form, wherein artificially PE was used to be avoided by many countries. Example that we took were anti-fragmentation rule, commissioner arrangement, which is nothing but agency PE, changes in definition of business connection, right? So based on the pillar of substance over form, and it is a reinforced international standards wherein company has to take certain measures by way of altering the definition of permanent establishment by way of altering the definition of permanent establishment in the respective treaty. So here BEPS Action Plan number 7, it is indirectly saying that this is a minimum standard which has to be, changes are to be made right away in the double taxation avoidance agreement or domestic tax provisions. India, if you see, has made changes in the definition of P as well as in the definition of business connection under section 911. Aligning the transfer pricing outcomes, which are nothing but value creation, intangible risk and capital and other high risk areas from 8 to 10. It is also reinforced international standards and concept of substance over form. Data analysis, it is nothing but monitoring BEPS activity, measuring and monitoring BEPS activity through which 6 indicators of BEPS were discussed, through which the tax administrators can come to know whether there is any BEPS activity or not. Pillar, the classification in the pillar is transparency and it is to be applied horizontally, that is without affecting the existing provisions. Mandatory disclosure rules as per BEPS Action Plan 12, it is transparency rule, however it is not a minimum standard. Re-examining transfer pricing documentation, master file, local file, CBCR. Pillar applicable is transparency and it is a minimum standard. Dispute resolution panel, action plan 14, it is based on transparency and it is also a minimum standard. Multilateral instrument, practically very much important. It is to be implemented, it is to be implemented horizontally as per objectives and as per outcome. Meaning it will be placed alongside the existing double taxation avoidance agreement. The existing double taxation avoidance agreement will retain its character. Only few provisions will modify the double taxation avoidance agreement. And as on date, if you see, if you go on the income tax website, there are MLI already published on the income tax website, the page where you get double taxation avoidance agreement. You will get for 29 countries that a synthesized text has also been published along with the existing double taxation avoidance agreement. So they sit alongside the existing double taxation avoidance agreement. They will be mandatorily applied for minimum standard and for optional provisions. Obviously, both the treaty partners have negotiated and choose to adopt those provisions. So friends, multilateral instrument, as per objectives we see and as per the outcome we see, it is horizontal provision. So friends, this concludes the topic BEPS Action Plan, Fundamentals of BEPS. Thank you.